The TSX is up approximately 15% year-to-date and sitting near all-time highs. The S&P 500 is up approximately 13% and also trading near record territory. Both markets are performing well by almost any historical standard, and both carry specific risks that Canadian investors should understand before deciding what to do next. This is the August 2026 Market Update. 5 things: where markets are, what drove the moves, whether the valuations make sense, the specifically Canadian picture, and what to watch in the next 60 days. The S&P/TSX composite sits at approximately 36,730 points as of August 14, 2026. Year-to-date price return, approximately 15.1%. One-year return, approximately 31.6%. The TSX has been outperforming the S&P 500 in 2026, which is a reversal of the long-running trend where the technology-heavy U.S. index typically leads the resource- and financial-heavy Canadian one. The sector driving that outperformance: financials and energy. Canadian financial companies now represent approximately 37% of the TSX, the largest share in 8 years. The Big Six banks have rallied strongly in 2026, with Royal Bank reporting record quarterly profit, and the sector as a whole trading at richer valuations than comparable U.S. banks. A remarkable reversal of the historical relationship. Energy was the strongest sector through the first half of the year, up approximately 27.4% through May, driven by elevated oil prices linked to the Middle East conflict. The S&P 500 sits at approximately 7,781 points as of August 14th, just below its record high from the previous session, pulling back 0.22% on Friday after retail sales data came in weaker than expected. Year-to-date, approximately 13%. 1 year, approximately 20.6%. The U.S. market's story in 2026 is the same story it has been for 3 years: AI and megacap technology. NVIDIA commands approximately 7.55% of the index. Apple, 7.04%. Microsoft, 5.36%. The top 3 holdings are approximately 20% of the entire index. The top 9 companies, including Meta, Amazon, Alphabet, Broadcom, Tesla, and Berkshire, represent over 38% of the S&P 500. This is the greatest concentration in at least half a century. Other key numbers: Canadian dollar, approximately 71.7 US cents. USD/CAD at approximately 1.3944. The loonie has weakened approximately 1.6% year-to-date against the US dollar. For a Canadian investor holding US-listed index funds or ETFs, that currency shift has added approximately 1.6% to their returns when converting US gains back into Canadian dollars. 3 distinct stories explain 2026 market performance. Understanding them separately is important because they carry different implications for what happens next. Story 1: AI infrastructure spending. The S&P 500's 2026 performance is substantially driven by continued massive investment in AI infrastructure. NVIDIA's data center revenue surged 217% year-over-year in fiscal 2025. Companies across the tech sector are spending aggressively on AI compute, software, and talent. And markets have priced continued extraordinary growth into the leading AI names. NVIDIA reached approximately $4.3 trillion in market capitalization by early 2026, the world's most valuable company. This is genuine business performance, not pure speculation. but the prices reflect enormous future growth expectations that must be delivered. Story 2. The Middle East, Conflict, and Energy Prices. The conflict in the Middle East has driven oil prices higher, creating a dual effect on Canadian markets. For the TSX's energy sector, higher oil prices have been a direct tailwind. For the Bank of Canada, energy-driven inflation complicated the rate-cutting path, pushing CPI to 3.2% in May, before easing to 2.8% in June as the conflict moderated. The Bank of Canada explicitly identifies the Middle East conflict as one of the two most important risks to its inflation and growth outlook. Story 3. Canadian Bank Strength, the Big Six. Canadian banks have driven TSX outperformance in 2026. Q2 2026, earnings across the banks were broadly strong. RBC reported profit up 19% year-over-year. TD delivered mixed but resilient results. All 6 banks beat analyst estimates, and most raised dividends. The financial sector's rise to 37% of the TSX index means the Canadian market's performance has become increasingly linked to one sector. The same sector that benefits from the current rate environment, but faces mortgage renewal pressures and credit quality questions heading into the second half. The honest answer: the U.S. market is expensive. The Canadian market is more fairly priced. Here is the data. The S&P 500 valuation. The S&P 500 trailing P/E ratio sits at approximately 26.5 times earnings. Guru Focus, August 2026. The forward P/E, what investors are paying relative to next year's expected earnings, is approximately 21.5 to 23 times. The historical long-run average forward P/E for the S&P 500 is approximately 15 to 17 times. The current level is stretched, not extreme by recent standards, but meaningfully above the long-run average. The Shiller CAPE ratio, which smooths earnings over 10 years to remove cyclical distortions, sits at approximately 42.3. The only time it was higher was during the dot-com bubble of 1999 to 2000. That does not mean a crash is imminent. The CAPE is a poor short-term timing tool. But it does mean the long-term expected return from U.S. equities from this starting point is lower than the historical average. The tech sector's forward P/E of approximately 35.6 times is elevated, but it is not the 50 to 60 times that characterized the dot-com bubble. The key difference: today's AI leaders, NVIDIA, Microsoft, Apple, have real earnings, real cash flow, and real revenue growth. The dot-com bubble was built on projections. This one is built on actual performance. Whether the actual performance can sustain what the prices imply is the question. The specific concentration risk: when 38% of the S&P 500 is in 9 companies, and those 9 companies all have AI-related exposure, a sentiment shift on AI spending expectations creates correlated risk across what appears to be a diversified index. Owning XEQT or VFV means 38% of the U.S. equity exposure rides on 9 names. The TSX valuation. The TSX trades at a significantly lower P/E multiple than the S&P 500, reflecting its heavier weighting in financials, energy and materials, and lighter weighting in technology. The Canadian market has historically traded at a discount to the U.S. market for this reason, and that discount remains. The TSX is not cheap by absolute historical standards. It is near all-time highs. But relative to the S&P 500, it is meaningfully more reasonably priced. The specific caution on the TSX: with financials at 37% of the index, anyone buying a broad Canadian index fund is accepting more single-sector exposure than the label diversified implies. The performance of the Big Six banks on Q3 earnings, reporting in November, will significantly shape the TSX's trajectory through year-end. Bank of Canada, sixth consecutive hold. The Bank of Canada held its overnight rate at 2.25% on July 15th. The sixth consecutive hold since cutting to this level in October 2025. The next decision is September 2nd, 2 weeks away. The BOC's key message: the economy has been weak but is recovering. GDP growth of 0.7% projected for 2026. Q2 GDP came in stronger than expected at an annualized rate of approximately 2.5%, erasing recession concerns that dominated early 2026. Inflation, CPI, was 3.2% in May, elevated mainly by gasoline, easing to 2.8% in June as the conflict moderated. Core inflation remains close to 2%. The BOC projects headline inflation returning to the 2% target in early 2027. The rate is currently 1.25% below the U.S. Federal Reserve's rate, a gap that puts mild downward pressure on the Canadian dollar. Governor Macklem has been clear: the BOC will not mechanically follow the Fed, but a sharply divergent path that cuts aggressively while the Fed holds would risk CAD depreciation that could reignite imported inflation. What does September 2nd bring? Market expectations are for a hold. Any surprise cut, if June GDP or July inflation come in softer than expected, would be a modest surprise. The BOC has also explicitly noted it is prepared to move in either direction depending on the Middle East situation and any shifts in the Canada-US trade relationship. The currency trade-off for Canadian investors: the Canadian dollar at approximately 71.7 US cents creates a specific dynamic for investors. For Canadians holding US-listed assets, the weak loonie has been a tailwind. A 13% S&P 500 gain in US dollars becomes approximately 14.6% when converted back to Canadian dollars. Because each US dollar is now worth more Canadian dollars than at the start of the year. For Canadians making new purchases of US-listed ETFs, the weak loonie makes them more expensive. Buying VFV today costs approximately 1.6% more in CAD terms than it did at the start of 2026 on a currency-adjusted basis. The BOC versus Fed policy divergence will drive USD/CAD through the rest of 2026. A Canadian dollar range of 68 to 72 cents is the consensus view for the second half, based on a cautious BOC, slower domestic growth, and strong U.S. performance. 5 things to watch in the next 60 days: specific, actionable, and directly relevant to Canadian portfolios. 1. Bank of Canada, September 2nd. The single most important date for Canadian investors in the next 60 days. A hold is expected. Any surprise cut would immediately move the TSX financial sector, the Canadian dollar, and bond prices. Any surprise hawkish language, if July inflation comes in hot, would have the opposite effect. Watch the accompanying statement as closely as the rate decision itself. 2. Canadian CPI, August and September releases. July CPI data will be released in mid-August. This data will be critical for the September 2nd BOC decision. If July inflation surprises to the upside, driven by energy prices, a September cut becomes essentially impossible. If July inflation continues to ease, a September cut becomes more plausible, even if not the consensus expectation. 3. U.S. Fed decision. September. The U.S. Federal Reserve's September meeting will move U.S. dollar to Canadian dollar, and thereby affect the return Canadian investors receive on their U.S. holdings. US CPI came in at 3.4% in July, easing but still above target. Consumer sentiment fell to 51 in early August preliminary readings. Retail sales dropped in July by the most in over a year. Markets are increasingly pricing in potential Fed rate cuts, which would weaken the USD, strengthen the loonie, and reduce the currency tailwind Canadian investors have been receiving on U.S. assets. 4. Canadian Bank Q3 earnings, November. Not in the next 60 days, but the most important single earnings event for the TSX for the remainder of 2026. With financials at 37% of the index, any significant negative surprise from one or more of the Big Six will have an outsized effect on the broad Canadian index. The key metrics to watch: mortgage renewal impairment rates, provision for credit losses, and net interest margin guidance for 2027. 5. The TSX RSI signal. Investing.com's August 12th analysis noted that the TSX monthly RSI has risen above 80, a level that historically precedes a 2% to 4% correction within 4 to 6 weeks. This is a technical signal, not a fundamental one, and technical signals fail regularly. But for investors considering adding to positions, this is worth noting. A 2 to 4% pullback on a 15% YTD gain would be entirely normal and would not change the long-term thesis. The bottom line for Canadian investors: both markets are performing well. Valuations on the U.S. side are stretched. The TSX is more reasonable, but increasingly concentrated in financials. The BOC is on hold and watching inflation carefully. The Canadian dollar is weak, a tailwind for U.S. holdings, a headwind for new U.S. purchases. Nothing in the current environment calls for dramatic portfolio changes. The September 2nd BOC decision and July CPI print are the most immediate data points to watch. The August 2026 market picture in 5 sentences. The TSX is up 15% year-to-date and outperforming the S&P 500, driven by Canadian bank strength and energy sector gains. But with 37% of the index in one sector, that performance comes with concentration risk. The S&P 500 is up 13% at stretched valuations, with the top 9 companies representing 38% of the index and all 9 tied to AI sentiment, which is a different kind of concentration risk. The Bank of Canada is on hold at 2.25%, watching inflation carefully, with the next decision on September 2nd. The Canadian dollar is weak, helpful for existing U.S. holdings, headwind for new purchases. U.S. consumer data is softening, which matters for Canadian exporters, corporate earnings, and the Fed's rate path. Nothing here screams sell. Nothing here screams load up. Markets are performing well with real underlying risks that patient, informed investors can navigate by staying the course, understanding what they own, and watching the data as it arrives.